We now come to the last and the largest section in this reading, which is business combinations. Business combinations involve the combination of two or more organizations into a larger economic entity. Under IFRS, there is no distinction among business combinations. We essentially have one company which is classified as the acquirer and the other company is the target. Under US GAAP, we have four types of business combinations: merger, acquisition, consolidation, and variable interest entity. In a merger, we have two companies, let's say A and B, which merge, and then we have a larger A in the sense that A is simply taking over B and becoming larger. B ceases to exist. With an acquisition, we have company A acquiring company B, and then we still have A and B operating as economic units, but A is considered the acquirer and A will report consolidated financial statements which include the results of company B. In a consolidation, we have company A combining with company B to create a new company called C. And finally, variable interest entity. This is a somewhat different model and we'll talk about this in detail towards the end of this lecture. How do we account for business combinations? Historically, two methods have been used: the pooling of interest method and the purchase method. The pooling of interest method has been discontinued. US GAAP discontinued it in 2001 and IFRS discontinued in 2004. This method gave way to the purchase method, and in fact when I took the level 2 exam in 2009 we had to study the purchase method. But now both US GAAP and IFRS require the acquisition method. Now we come to the acquisition method, which is the method that has to be used according to both US GAAP and IFRS. Recognition and measurement of identifiable assets and liabilities. Here there are two major points. The first is that assets and liabilities are brought over at fair value. The second point is that if the investee or the company which is being acquired has developed some intangible assets such as copyrights or patents, and since those intangible assets which are identifiable have been developed internally, it is possible that the book value is zero. When those intangible assets are brought over to the balance sheet of the acquiring company, then even these assets which have a book value of zero need to be brought over at fair value. So if a given copyright has book value of zero, but the fair market value is 5 million, then that intangible asset needs to be brought over at 5 million. Recognition and measurement of contingent liabilities. Here I will read the relevant excerpt from the curriculum. On acquisition date, the acquirer must recognize any contingent liability assumed in acquisition if, number one, it is a present obligation that arises from past events, and number two, it can be measured reliably. There is a subtle difference between IFRS and US GAAP on this front. IFRS includes a contingent liability if the fair value can be reliably measured. US GAAP includes a contingent liability only if the contingent liability is probable and can be reasonably estimated. Next point has to do with the recognition and measurement of indemnification assets. If you don't know the meaning of this term, I suggest you look it up on investopedia.com. Again, I will read from the curriculum. On the acquisition date, the acquirer must recognize an indemnification asset if the seller or the acquiree contractually indemnifies the acquirer for the outcome of a contingency or an uncertainty related to all or part of a specific asset or liability of the acquiree. I don't think this is a hugely important point. Just keep in mind that if the acquiree is effectively giving a benefit to the acquirer and that can be quantified, then that benefit is shown as an asset. Recognition and measurement of financial assets and liabilities. When the acquiring firm acquires the target or the acquiree, and this particular firm has some financial assets or liabilities, then those obviously come to the balance sheet of the acquirer. The target will have categorized these financial assets in a certain way. If you recall from an earlier segment, this categorization could be held to maturity or available for sale. When these assets are brought over, then recategorization needs to take place based on the economic reality at the acquiring firm. When an acquisition takes place, there is goodwill if the price paid is greater than the fair value of the net assets which are brought over. As we will see in an example, there are two ways of measuring goodwill. One is called the partial method, which leads to partial goodwill, and the other is called full goodwill. IFRS allows us to use both methods, the partial goodwill method or the full goodwill method, whereas US GAAP requires the use of full goodwill. And when we do the example on the next slide, we will understand the calculation for both methods. Recognition and measurement when acquisition price is less than fair value. When this happens, then the purchase is considered a bargain purchase or a bargain transaction, and the difference between the acquisition price and the fair value is shown as a gain on the income statement. Now let's take a look at example 6, which demonstrates the calculation of partial goodwill and full goodwill. Note that IFRS allows both methods, whereas US GAAP says that we must use the full goodwill method. We have a very simple scenario. The acquirer acquires another company called the acquiree, and the total value of the acquiree is 1 million. But the acquirer acquires 80%. So 80% of 1 million would be 800,000. The total fair value of the net assets is 900,000, and 80% of 900,000, which represents the share of the acquirer, would be 720,000. Given these numbers, there are two ways of coming up with goodwill. The full goodwill method says that we take the total value of the company, so that is 100% of the company, minus 100% of the net assets. This again is the fair value of net assets. The difference between these two is 100,000. This is the full goodwill. The other approach is to take the 80% share and say that 80% of the company is worth 800,000. 80% of the net assets are worth 720,000. The difference is 80,000. So this would be the partial goodwill. And again, I've said this several times, but I will repeat. This is one of the major differences between IFRS and US GAAP. IFRS says that both methods can be used. US GAAP says that the full goodwill method should be used. Let's work through example 7 now, which demonstrates the impact of acquisition on financial statements. And I want you to read this first so you understand what's going on. To summarize the main points, we have Franklin Company, which is the acquirer, and for simplicity, we are saying that Franklin acquires 100% of the acquiree. Acquiree firm is Jefferson. This acquisition is taking place by issuing 1 million shares. Each share has a €1 par value and a €15 market value. So the total amount that is being paid is 15 million. The first thing that we should do here is figure out goodwill, and that is easy to do. Since we have 100% acquisition, we don't really worry about the difference between partial and full goodwill. The goodwill here simply will be 15 million, which is the amount paid, minus the fair value of net assets. The fair value of net assets is 5.4 million. So the goodwill amount is equal to 9.6 million. If we work in thousands, the way the information here is presented, the goodwill is 9,600. Now let's take a look at the balance sheet of the consolidated company. Remember that assets and liabilities are based on the fair value of the assets and liabilities of the acquired company. What happens to cash? Franklin is 10,000, and then the fair value from Jefferson is 300. So the value of cash will be 10,300. Inventory is going to be 12,000 plus 3,000, which is 15,000. Property, plant and equipment is going to be 27,000 plus 4,500. And then the assets will also include goodwill of 9,600. You can come up with all the numbers and show the consolidated balance sheet. The next slide will give you the exact answer. On the liability side, current payables would be 8,000 plus 600, which would be 8,600. Long-term debt would be 16,000 plus 1,800. Note that we are using the fair value and not the book value. The equity then will be the difference between the assets and liabilities. Here is the consolidated balance sheet. We've talked about these numbers already. The total assets are 66,400. We've talked about liabilities. This is the total liability amount. You subtract liabilities from assets and you will have total equity of 40,000. The next question is, how do we come up with this categorization of the 40,000? Capital stock is 6,000, additional paid in 20,000, and retained earnings 14,000. The way you come up with this is by looking at this information. Note that the par value is 1. If 1 million shares are issued, then the capital stock will go up by 1 million. Initially, our number was 5 million. When capital stock goes up by 1 million, we will have 6 million. Additional paid in capital is the amount that is paid above the par value, and that number is 14 million. Since 15 million is being paid, of which 1 million is going in this category, then the remaining 14 million go in the additional paid in capital category. So we do 6 million plus 14 million, that is 20 million. The retained earnings stay the same, that number is 14 million. So that is where these three numbers come from, and note that they add up to 40 million, which is what you would expect.